Your Excellencies, ladies and gentlemen, members of the press and of the diplomatic corps, thank you very much for coming to this annual gathering, to the exclusive preview of the results of the World Economic Forum's Global Competitiveness Report. It is the 30th year this year that we are publishing the Global Competitiveness Report. Before going into details with the author, Dr. Jennifer Blanke, on the report, I would like to give the floor to our Executive Chairman and founder of the World Economic Forum, Professor Klaus Schwab.
Good evening, Your Excellencies. We are delighted to have you here this evening. It's a very difficult time at the moment. As we all know, the world is in crisis. I think it's very important not to be only crisis-driven, but to look at the fundamental factors which drive actually an economy. And that's what we want to do with the competitiveness report. As it was mentioned, I published the first report, and I'm still proud of it, 30 years ago. And the idea at that moment was to define competitiveness in a completely different way. As an economist, I was taught that competitiveness resides mainly in capital and labor productivity. And I felt at that time, no, we have to widen the definition, and we have to introduce really all those factors which are important for the future of an economy. For example, its capability to do research, its educational system, its social system, and so on. And that was done in the best tradition of the World Economic Forum, to combine economic issues and social issues. We are proud how the report has developed in the last 30 years. It has a major impact on the global discussion, and we are very happy to present to you this evening the results. And I underline results because this is not a report which the Forum writes. It's a report which is based on an analysis of facts and figures, but also it's mainly based on a survey with many thousand people around the world contributing to the scores, to the competitive ranking. Just one word, if you allow me, because I see here in the room a number of people with whom we are in close contact in the preparation of the next annual meeting in Davos. We speak today with the report about the long-term factors. We structure now our annual meeting in Davos in such a way that it really provides an opportunity for global leaders from politics and business to assess the present situation, to learn from the crisis and the mistakes which have been made in the past, and to see what could be done in order to recreate sustainable economic growth. And we have a tremendous response to this objective of providing a true economic summit to the world, which will be to a large extent crisis and post-crisis related. So I have now the pleasure to ask Dr. Blanke, Jennifer Blanke, to present to you the report. It's a preview because we will officially make it public on Wednesday. So it's actually, you are the first who learn about the results. We do it with the intention that you can prepare your governments, because there will be certainly a lot of press coverage, that you can prepare your governments and that you know why we have scaled your country in one or the other factors in a very specific ways. I would like to thank the team, and I would like to thank particularly Fiona Power, who may be here during the discussion time, who is our Senior Director for Research, Strategic Insights and Publications. Jennifer, please.
Thank you, Professor Schwab. I'm very pleased to be here today to be able to talk to you about the work that we've been doing on competitiveness at the World Economic Forum in the tradition of Professor Schwab's research going back to 1979. Before talking about the results, I just wanted to take a moment to thank the team who has really put a lot of work into this report, as well as a number of related reports that we're doing. I'd like to thank Fiona again for her leadership. Fiona, who's basically the head of our research department here, in which our team is located in the house. And I would like to thank also, and I will point out, I would like the members of the team to maybe stand up, just because especially during the discussion period, you'll know who to go to if you have particular questions. So I'd like to ask Irene to first stand up. Irene is a senior economist as well as a director here at the World Economic Forum. There's also Margareta Jeniak, who is over there without a seat. She's also a senior economist and a director, and so can also provide a lot of interesting information about the report. Thierry Geiger, who is an economist and a global leadership fellow at the World Economic Forum. Kira Brown, who's our senior community manager and who's very much responsible for our relationship with our partner institutes and handling the survey process, among other things. I'd also like to thank Eva. I don't know if Eva's in here. Well, I think a few of our team members are manning the desk outside. So Eva Trujillo, who is our research assistant, as well as Pearl Samandari, who I think is still out there, manning the floor, who's our coordinator for our team. So, and also Agustina Siosia, who is on vacation, lucky duck, and so she's not here right now. So with no further ado, let me just let you know what we're going to talk about. I'm going to try to do this quite briefly. I know that some of you have been here before, so this will be sort of a refresher course for those of you who aren't that familiar yet with our research. It'll give you a flavor of what we do before we talk about the results. So what I'm going to do is I'll talk to you a bit about what our team does in general at the Global Competitiveness Network. After that, I'll go into more detail on the Global Competitiveness Report and what makes it interesting, as well as the Global Competitiveness Index, which to date is the vehicle that we've been using in the report for measuring and ranking countries according to their competitiveness. And finally, of course, the main reason we're here, I'll go into some detail on some of the key findings from the report from this year. So basically, just a few words about the Global Competitiveness Network. As Professor Schwab mentioned, our flagship report is the Global Competitiveness Report, which was launched back in 1979, 30 years ago, basically counting now a number of years of actually producing the report. At that time, we were covering 16 economies, European economies, because that was the main focus of the World Economic Forum at the time. Over the years, the report has expanded its coverage to different regions in the world, countries at all different stages of development. And as of this year, we're covering a record number of 134 economies. Our co-editors and co-directors of the report are Professor Schwab and Professor Michael Porter from Harvard Business School, with whom many of you are probably familiar. And our goal is basically to provide a benchmarking tool that can provide a vehicle for discussion between business leaders and government officials in looking at how to improve the competitiveness of their country. Now, that said, you know, it's our main report. It's the one we've been doing for the longest time, but we do a number of other related reports, and these are just the ones that have either come out very recently or that are coming out soon. And just to give you a flavor, we have a travel and tourism competitiveness report that we've been doing for a few years. It's an annual report looking exactly at that industry. We have a global information technology report for which Irene is responsible, and that we've been doing since 2001, since 2002, with INSEAD really zooming in on the networked readiness of countries around the world. We have a global enabling trade report, and that one Margareta is responsible for, and that is a new report that we just came out with, obviously of interest to people here, really looking at the extent to which countries have in place all of the factors and policies that facilitate the free flow of goods over borders and to destination. We also recently came out with a financial development report. Thierry was very involved in that one as well. And finally, two forthcoming reports are the Lisbon Review. It's a regional report looking specifically at Europe. And that one we will be releasing in about 3 weeks at the occasion of our Europe Summit, Europe and Central Asia Summit. And finally, a global gender gap report, which is something that we've been doing for a few years, really looking at the gap between men and women in different aspects of society, economy, education, politics, etc. Okay, so enough on the background. So what are we trying to do with the Global Competitiveness Report? What is our goal? And what are we trying to understand? This, I think, is quite eloquent. If you look at this graph, basically it shows you the path of prosperity, GDP per capita in purchasing power parity terms over the past 27 years among 3 different countries. You see Korea, Chile, and Nigeria. And what you see is that all 3 started off, not so far from each other back in 1980, but that they followed quite different trajectories since then. Korea really just, off the charts. Chile doing quite well, and then Nigeria basically doing a bit of an improvement over time, but more or less pretty much at the same level that it was before. And so what we're trying to understand is why is it that some countries have been better able to provide rising levels of prosperity to their citizens than others. So why is this report interesting? It has a very comprehensive data set on competitiveness, both in terms of the number of countries covered, really more countries than in any other study of its sort, as well as the breadth of issues that we actually cover in the report, and we'll look at those in a moment. What we're trying to do is assess the comparative strengths and weaknesses across a large number of economies, and it's not something that we do on our own. We work together, as I mentioned, with Professor Michael Port at Harvard Business School, Xavier Sally-Martin, who's a top economist at Columbia University, and also, very importantly, with a large number of partner institutes that are operating in each of the countries that we cover in our analysis, who both help us to gather the data that we need to carry out the analysis, but also to interpret the results at the national level afterwards. We use 2 different types of data. We use hard data, and that can come from any kinds of national sources. We always try to go to the source that is best known for that particular kind of data. So macro data we get from the IMF, education data we get from UNESCO, IT data we get from the ITU. But importantly, we also use survey data. Survey data, as was mentioned, comes from our own executive opinion survey. And this is a survey that we carry out in all of the countries that we cover in our analysis, asking basically CEOs and top executives to compare their operating environment to an international standard. And so it helps us because it gathers, first of all, the perspective of the business community, those people actually making the investment decisions, very important for a country's competitiveness, and also allows us to capture qualitative data, which cannot be captured in the hard data statistics, but which is nonetheless very important for the functioning of an economy. And this shows our global coverage, basically. This map shows that we really are covering the large majority of the countries in the world. The gray are countries that we covered until this year. The blue and a couple of the countries are a little bit too small to even see, but are the countries that we added this year. And at this point, we're basically covering well over 98% of global GDP. So the results are quite global in scope. There are some countries, particularly in Central Africa, that we haven't been able to cover yet. It's very hard to carry out a survey in these countries. Okay, so now moving to the Global Competitiveness Index, which, as I mentioned, is the index or the vehicle that we use in our reports for measuring and assessing competitiveness. What is it that we mean by competitiveness? Now, what we don't mean by competitiveness, and this is important because there are many definitions out there. People think about price competitiveness, they think about a lot of different things. We do not think about competitiveness as a share in the world market for a country's goods. That's the way you would think about maybe competition between a couple of companies over a fixed market share. Cutting up the pie into smaller pieces. That's not the way that we think about it. It's not a zero-sum game in our opinion. We do define competitiveness as a set of institutions, policies, and factors that determine the level of productivity of an economy. Of course, it's a level of productivity that will basically set the sustainable level of prosperity of a country. Now, just before I show you the model, which will be the next slide, another important thing that we had to take into account as we included more and more countries from different stages of development into the analysis is how do you rank countries together at very different stages of development? Can you consider that the things that are important for the development of Chad are the same as those for France? And clearly that is not the case. And so what the model does is it takes into account that countries are at different stages of development. And we simplify into saying there's basically 3 stages that are quite logical. Countries will start off at the factor-driven stage. At that stage, they're basically competing based on low prices and low wages. So you will produce in the country because it's cheaper to do so than elsewhere. But if a country is competitive at that stage, they do things well, productivity is enhanced, prices will rise, wages will rise, and at some point they can no longer compete just by being cheaper than elsewhere. At that point, they will be moving into what we would call the efficiency-driven stage, because the way they compete at that stage is by doing things better than elsewhere, more efficient production processes. But we have the same story again. If a country is very competitive at that stage, the way we define it in terms of improving its productivity, prices will continue to rise, wages will continue to rise, until one is at the point where you can no longer compete either by being cheaper, because things are much more expensive, or even by being efficient, because prices have gone up so much that at this point, in order to keep driving productivity forward, you need to come up with new products and processes. And these are the countries that have basically reached the high-tech frontier. So those are sort of the building blocks, and this is sort of the last slide that I'll show you before going into the results. I'll show you one other really quickly. But so this is the model, and I think you can sort of grasp how the stages fits into it, but just a few words on each of the different pillars that we look at. We basically say that there are 12 pillars of competitiveness, and they range from the more basic factors that drive productivity or sustain productivity to the more complex. And so we're looking, and I'll go from top to bottom, at things like institutions. And then we're looking both at public institutions, so really government institutions, but also the judiciary and how independent is it. We're looking at property rights. We're looking at government's efficiency in spending, public trust of politicians, and things of that nature. But we're also looking at private institutions, things like corporate ethics. The second pillar is infrastructure. And there we're looking at really the quality of infrastructure, transport infrastructure, electricity, telephony. The third pillar is macroeconomic stability, inflation, are debt levels sustainable, have countries been running up budget deficits, things of that nature. The fourth is health and primary education, and there we're really looking at the basic health of the workforce, as well as access to primary education and the quality of the primary educational system. Moving into the things that are a bit more complex, we look at higher education and training, and that's really secondary and tertiary education enrollment, as well as the quality of the educational system, and on-the-job training, provided a lot of the time by companies. Then the sixth through the eighth pillars are looking at the efficiency of markets. There's goods markets, labor markets, and the one that's been getting a lot of attention of late, financial markets. Technological readiness is the ninth pillar. That's the extent to which countries are actually adopting technologies, whether they were developed at home or abroad. The 10th pillar is market size, because obviously large markets, either in terms of the domestic market or the potential export market, allow for huge economies of scale. And finally, we look at the two most complex, our business sophistication, things like clustering, the quality of suppliers, the quantity of suppliers, and finally innovation. That's really the endogenous innovative potential in the country to come up with new products and processes. So those are the 12 pillars, and basically they're organized into 3 different groupings, or we would call them sub-indexes, each of which are key for countries at a particular stage of development. All factors matter for all countries, but the weighting will change based upon a country's particular stage. So what we're saying is that a country like Chad can still get a big kick in its productivity by getting its infrastructure in order, or even getting its macroeconomic environment in order, whereas a country like the US or France or Japan needs to be doing everything. So we start to weight the later or the more complex things more. We're not saying that the more basic things are not important for a country in an advanced stage of development, but they need to be doing everything right. And those are just the countries organized by stage. So, the rest of the time we're going to be talking about results, which I think is the most interesting part. I think the first thing to mention is that the United States is still first, which I'm sure a lot of you noticed, and which might raise eyebrows, given what's going on in the financial markets right now. But it's really important to remember that slide with all those 12 different factors that we were looking at. We really take into account many different things when we think about competitiveness. And the US is doing so well in a lot of the other factors, such as the level of business sophistication, the innovative potential, or innovation potential of the country, the flexibility of its labor markets, the functioning of its goods markets, the educational system, the networking between universities and the business sector in R&D, in development of new ideas. So, as well as its huge market size that allows for enormous economies of scale. I think that there are two messages coming out of here. I mean, at the same time, the U.S. Has definitely been demonstrating for a number of years the weaknesses in the macroeconomic environment, and this is still a big concern. The U.S. is very low on that pillar, as a matter of fact. But the fact that it's doing so well in the other areas still keeps it at number one. Doesn't mean that this will be the case forever. And that brings me to my second point. Well, the first one is, you're looking at a lot of different aspects. Financial markets is important. We're going through a big shock right now, but there are a lot of other aspects that are very important as well. Also in terms of giving you a sense of how well the country can bounce back. But also it's important to keep in mind that the data is not from today. We don't have the latest chapter of the financial crisis in the data that we're looking at today. It's impossible. This is a benchmarking exercise. It's supposed to be taking a longer-term view. It is possible, depending on what happens and how bad things get, but the next time we collect data, that we might start seeing differences and more of an effect of the financial market crisis in the results. But for now, still, the message is pretty much you need to be looking at the entire picture. In terms of some of the other countries, we see that the Nordic countries continue to do very well, particularly Denmark, Sweden, and Finland, that are all in the top 6 of the ranking. Same story as we've been sort of telling in the past. Very well-run macroeconomic environments, basically saving for the future. They have very transparent and well-functioning institutional environments, government institutions, and they've placed a big emphasis on education in recent years, which has been an important boon for innovation in those countries. Singapore is the top-ranked Asian country. Singapore doing very well, particularly in the functioning of its markets. It's ranked 1 or 2 in all of the 3 markets that I mentioned, labor, goods, and financial markets. It also has a very strong institutional environment, among the best in the world in terms of trust in politicians, lack of red tape, and things of that nature. And it has actually gone up because of even improvements in various aspects of the institutional environment vis-a-vis other countries, or perhaps other countries worsening in these areas. Germany, still in the top 10, doing very well across a number of areas, very innovative, excellent business environment, great infrastructure, all the things that we know. Japan, again, still in the top 10, innovation powerhouse, that's the country's main strength. But again, sort of like we're seeing in the US, big weaknesses in the macroeconomic area, which over time is actually eroding a bit of the country's competitiveness potential. UK, I heard some people mentioning that they noticed as you were walking in that the UK has gone down. Yes, the UK went down by 3 places this year. The UK continues to be quite competitive, we would say, but and still doing well in terms of labor market flexibility, business innovation, and things of that nature. But the financial markets actually are, even the data that we collected up till now, is actually showing itself in these rankings. The UK has gone down by 3 places actually in the financial markets pillar. And basically due to the things that won't surprise you, sort of less credit, concerns about the solvency of the banking sector, and so this is explaining why, in great part, the UK has gone down a bit. Maybe some of the other countries, I put the top 20, as well as some other countries of interest. Turning to other regions, we see that Chile continues to be the top-ranked country in Latin America. And still, sort of really by far being the beacon, doing really well for a number of reasons. great macroeconomic stability over recent years has really freed up resources for investment in upgrading infrastructure, the educational system. Markets are quite well functioning compared to many other countries in the region. China has gone up by 4 places this year. China is by far the most competitive of the large emerging market BRIC economies and continues to do very well. I mean, it has not only an enormous domestic and sort of export market size, but a growing one, increasingly doing very well in the area of innovation as well. In terms of weaknesses, obviously need to sort of upgrade the educational system, infrastructure, and improve the functioning of markets, as well as private sector institutions in the country. The United Arab Emirates continues to be one of the highest ranked countries in the Middle East, North Africa region. And actually, we've seen a trend among the Gulf states. Most of them have actually gone up this year, partly because of an improvement in their macroeconomic outlook based on the high hydrocarbon prices, but also a real focus in many of the countries on a reform process and improving the business environment, and this seems to be paying off in the rankings. UAE doing very well in terms of its institutional environment, as well as we're seeing improvements even in the educational sector, which is one of the reasons that it has gone up, and so on and so forth. Also better adoption of technology and things like that. Estonia continues to be the highest ranked of the new accession, or the recent accession countries since 2004 to the European Union. Estonia has gone down a little bit, partly in line with sort of the economic, I'd say, malaise a little bit in the Baltics. We've seen a weakening across a number of areas, but Estonia still continues to be a very well-rated country overall, with very transparent, well-functioning government institutions, a very large focus on technological adoption, for example. South Africa, turning to sub-Saharan Africa, continues to be the highest-ranked country in the region, and with a very stable, actually, performance compared with last year, and continues to do well in a number of the more complex areas, actually measured by the index, particularly business sophistication, innovation, especially by regional standards. This is something that is a clear strength. India, among the BRICS, also basically pretty stable in its performance since last year. Doing very well, again, in quite complex areas, obviously benefiting a lot from its large market size, but also high levels of business sophistication, as well as quite good higher education, although not necessarily touching enough people in the country. So sort of enhancing educational attainment and things of that nature will be very important, as well as addressing health concerns in the country will be very important for India going forward. Turkey is a case of a country going quite a bit down in the rankings this year, 10 places after having gone up a bit last year. And this is mainly traced to concerns about governance in the country in terms of much less public trust in governance and things like that. And I might just also mention Brazil. Brazil's actually gone up in the rankings this year. An improving macroeconomic outlook, reducing debt levels, or a country that actually is doing quite well in terms of business sophistication, in terms of adopting technologies, ICTs and other technologies for productivity enhancements, but still some work to be done, even though the macroeconomic outlook is looking better, still some work to be done to bring debt levels lower. And I maybe would just wrap up with Zimbabwe, a country, it's actually second to last before Chad, and it has just continued its precipitous drop in the rankings, which perhaps is not a surprise given the situation down there. So I think that's basically what I had to say to give you a general flavor of what's going on, and I welcome.
Jennifer, thank you very much for this roundup. Just to remind you, this index is under embargo until Wednesday, 1500 Geneva time, so That's 1300 GMT, so please respect the embargo. This is an exclusive preview. And before going into questions, if you just identify yourself, which organization you're coming from. We'll start here in the first one.
And can I just ask one other question? If you have very specific questions about your own country, can you hold them until after the main presentation? Because we can go much more into detail with you one-on-one afterwards instead of sort of, taking up everybody's time to go into these issues. Thanks.
Ratings agency.
This should work, yeah?
I have a question about the United States. How do you explain that you put I know you said whatever you said about the United States. How do you explain the loss of 800,000 jobs this year, 159,000 in September, the mortgage crisis, and before that the Enron and other crises that went through the economy of the United States, and how this is still ranked top? And my second point is I have full admiration for the United Arab Emirates, but why didn't you mention Qatar and Saudi Arabia, which rank higher than the United Arab Emirates? Thank you.
Okay. I think it's easy. I can answer the second one first, which is that I didn't mention every single country. I just put a selection of countries up there that I thought would be interesting. So, I did mention the fact that the Gulf countries tend to be doing better, which is the case for the countries that you mentioned, except for Kuwait, I think, but I'll allow Margareta, who's our Middle East North Africa expert, to answer that. But I think one-on-one afterwards. In terms of your first question about how can the U.S. be up there, you have to remember that we're looking at structural factors. We're not looking at the business cycle. And we're also not necessarily looking at shocks as big as they are. And we all know that the party went on for a really long time, and now we're facing a huge correction. But that does not mean that the other characteristics of an economy are not important, right? Just because there's a huge financial crisis doesn't mean that we can forget about how good an educational system is, or Silicon Valley, or whatever it is that is actually driving productivity in an economy. And so what we're saying is, it's very important that everybody's focusing on the financial crisis, don't get me wrong, because we have to try to fix this thing if we can, because it can do a lot of damage in the short to medium term, but that it also is very useful to take a longer term view, to not forget about a lot of the other things that matter. In the US, often the US, like other countries, go through crises, but the fact that the US has a much more flexible labor market, for example, means that as well as losing jobs quite quickly, coming out of a crisis, the U.S. tends to hire people back more quickly. And so these are the sorts of things that our index takes into account. And, I know that we're going to get a lot of questions about this, but at the same time, we really felt it was important to come out with this message at a time when everybody's very focused on the downside and only on one aspect, an important aspect, but only one aspect of many things that drive competitiveness in economies around the world.
Hi, Lisa Schlein, Voice of America. Adding on to the question that my colleague asked, the United States is tanking. First of all, when did your survey end? To get a perspective of where it ended and where we are now. And since the U.S. economy is going down, it seems to be dragging everybody else with it. So could it conceivably come out first yet again, simply because there's a progression of everybody following the leader, in this case downward instead of upwards? Do you have some predictions as to where this might actually go? And if I could jump to Africa, it's kind of amazing that Chad has outdone Zimbabwe.
No, it did.
I mean, in terms of being worse, which seems a little amazing when you think what's okay. But in terms of Africa, what is the general sense? That countries are generally improving. Some countries, I suppose, remain in the lower ranks, and there's little you can do about it, but what is happening?
Let me actually leave that with her, because I don't know if I'm going to remember all of her questions. Let me answer the last one first, because I remember what you asked. In terms of Africa, we actually are seeing quite a positive trend, and it's something that we have been waiting for some time. In many of the countries in the region, there are slight improvements in the ranking, sometimes not so slight. So we are seeing some reflection of the improvement in the economic environment that we've been sort of noticing over the past few years in terms of the growth numbers. At the same time, remains the case that sub-Saharan Africa as a whole, with a few shining stars setting themselves out, remains sort of the least competitive region at the aggregate. Just because in terms of endowments, and I mean endowments of education, infrastructure, and things of that nature, there still is a lot more to be built up down there, and that takes time. And so the other questions were?
Had to do with the cutoff.
Oh, in terms of the survey data. We carry out the survey every spring. And so this was carried out, I mean, Kira, we got most of the surveys back in like June or May? May, okay. So January to May. So, I mean, we did catch the first part of the crisis. We just haven't caught this really scary recent part that's going on. And I think that sort of ties into your other question about whether if it pulls down all the other countries, does it mean the U.S. is still number one? Well, I mean, you have to remember that we're looking at all these different factors. If the U.S. continues to do really well in other factors, that will continue to help. Now, if the financial markets start to actually, and the breakdown and the lack of credit actually start to impinge on the U.S.'s ability to invest in a lot of these other areas that are really important, like education or R&D, the availability of venture capital and things of that nature, then you'll probably see it actually really affecting its competitiveness going forward, but only time will tell with that. I don't think that we can make any, we don't have a crystal ball. I think anybody would love to have that right now. And yeah, these are relative rankings, so if everybody goes down just in one area, then the ones that are better in those other areas will continue to be doing better.
Yes, John Zaracostas, I'm a freelance writer for newspapers in Europe, North America, and Asia. I have a question, if you can walk us through one of your 12 key components, the financial institutions, and who's doing very well and who's doing very bad. And secondly, an analysis on why India has gone down 2 rankings, even though it's posting 89% growth, and the fundamentals look good on prudential safeguards.
India. Okay. Well, India, can you guys get me the financial markets pillar or something? On India, as I mentioned, India is doing very well in some areas. It's doing extremely well in a lot of more complex areas, such as I mentioned, business sophistication, innovation. But India still has a number of weaknesses. One of them is also labor markets, quite sticky labor markets, for example. While having some very good IITs, some very good schools, is touching a very small portion of the population, and that is also very, very important. And until these sorts of things, which are really structural in nature, are dealt with, you can have lots of money coming into the country, you can have lots of investment, but for this to really feed through, to rise the prosperity levels of the country, it's going to take some time. And then in terms of financial markets, even just, does anybody have the chat? Yeah. That's great. So financial markets, you're wondering who's at the top. Okay. And you think we have all of this in our heads. We have most of it in our heads. Oh, and it's not ranked in the right order. Terrific. Financial market sophistication. And we have countries like Denmark, Hong Kong. Hong Kong's ranked number 1, for example. Denmark's number 4. Sorry, I'm having to look at this in alphabetical order, which is super helpful right now. New Zealand is ranked 3rd, which is interesting. Sweden 8th. So the Scandinavian countries, the Nordic countries tend to do very well. The United Kingdom is in the top 5. It's ranked 5th, but it has fallen from 2nd to 5th this year. And keep in mind that we haven't, I think that we must have been collecting the data, was it pre-Northern Rock, or it was just about that time. So we haven't collected, the data that, I think that might end up being worse coming up next year. So
Where is the US in your rankings?
quite a bit lower, I think. 1 second. 9th. Yeah. So there you go.
Geneva. It's not a question about one country, but a group of countries. Let's say the first top 5 countries. I would like to know what are the missing links that explains why these countries don't have the 10th point, but they have only 5.74 or 5.61. What are the missing links? What these countries ought to do more to have those 10 points?
So I'm not sure if I understood exactly. So which countries?
Top 5.
The top 5? Oh, so what to have to be out of 7? Well, no country's out of 7. So in the U.S., it's really cleaning up its macroeconomic house. Huge budget deficits over time, running up enormous debt levels. We're seeing a huge current account deficit that's also the result of basically extremely low savings in the country. And these are the sorts of things that are keeping the U.S. from being a 7. As well as, it has weaknesses in various areas. It's strongest in the areas of innovation, technological adoption, and things like that, but can also have some improvements. Institutions is another area for the U.S. Trust in the government. This is an area we've been seeing kind of going down over the past few years, a sense of the wastefulness of government spending. If you look at Switzerland, part of it's just market size. It's just not a huge market. It has to do things on a smaller scale. If you look at Denmark vis-a-vis, say, Sweden and Finland, actually, Sweden and Finland will be doing worse in the labor market area, right? Because Denmark is the one with a flexicurity system and actually very, very well assessed for labor market flexibility and efficiency, much better than Sweden, Finland, and a lot of other countries. So it really depends on the country. It's all very country specific. But no country is a 7, not yet.
Thank you. I'm Jonathan Miller from Reuters. A lot of the comments around the financial crisis recently has been that there's something wrong with unfettered markets. The markets have been allowed to get out of hand. And then if you look at the financial problems specifically, a lot of the problem seems to be very innovative, clever products, very sophisticated business structures that allow things to be put off balance sheet. So I'm just wondering whether you're having any second thoughts about some of your 12 points.
Yeah. No. Basically, I think one of the big concerns that a lot of economists are having right now is that the pendulum doesn't swing back too far in the opposite direction and that we don't end up with overregulation. Because obviously in financial markets you do want to have innovation. The question is, where do you draw the limit? And I think that that's what we're all going to be figuring out over the coming 6 months. And what is the acceptable level, and what do you do about cross-border financial flows? But no, I don't think that we think that it's good to have an overregulated or completely regulated financial market. At the same time, you have to avoid abuses, as we've seen, and I'm not an expert on financial markets, so I'll defer that to the financial market whizzes in governments around the world to figure out.
Thank you. USK from WTO. 2 questions. One is on the ranking myself and how to interpret that. At the beginning of your presentation, you say that you wanted to avoid the zero-sum game story like the reveal competitiveness. Unfortunately, by putting emphasis on rank, you're doing exactly that. Because if 2 countries are improving, but one is improving more than the other one will lose ranks. So I'm a bit comfortable with that. But I wanted to ask you, you are using surveys, so that there's some margin of uncertainty. So to help us to interpret what's really the significance of 5.41 versus 5.42, what would be the percentage of uncertainty to compare country? The second question is a bit related to your last comment. I'm surprised to see, that in the top 10, we just have 2 Anglo-Saxon type of economy, while the other one is are more regulated, European-style capitalism. So does it tell a story on competitiveness? Thank you.
Thanks. So the first question about the irony between trying to not look at a zero-sum game and have rankings, you're right, it's a bit ironic. And that's why we always stress the fact that the reason that we have overall rankings is to focus attention. Rankings focus attention. People can get their head around it, governments pay attention to it. That's why everybody's here right now. But the real usefulness of this as a tool is in the details. And so, regardless of whether a country goes up by 2 or down by 2, which frankly is not statistically significant, I agree with you. And I think we all would agree with you, particularly when the scores are very close to each other. It still tells you a very important story about what's going on in your country and where are the strengths and weaknesses in the areas that should be focused on. So we kind of have to come out with a ranking. It helps people to understand and organize their thoughts and get interested in what we're doing, but the usefulness is really in the overall story behind all of this. Your second question was on...
well, within the top 10.
Within the top 10, how much does all of this matter? Look, I mean, when countries are probably within 2 or 3 ranks, and certainly when their scores are very close to each other, we certainly wouldn't say that it actually, has a statistical significance in the case of the difference. The ability to quantify it is very difficult. This is a mix of survey and hard data. Certainly the countries that tend to be at the top tend to be very, very close to each other. And so you do need to take it to a certain extent with a grain of salt. The data is what it is. It's the best data that's out there for this purpose. It is the only data that's out there to do this kind of exercise. We've actually been working a lot over the past year in improving the data set. We've been working with a leading survey company actually to improve the process and the treatment of the data, and it's an ongoing process. I mean, everybody who deals with survey data deals with the same thing. And then I think you had another question.
Yeah, I'm saying within the top 10, only 2
our regulatory. In terms of regulated or non-regulated, I think it depends. Korea is also a case of huge regulation leading to a huge growth trajectory. It probably depends a lot on how it's done and how much trust you have in the regulators to do the right thing. I think in these countries the regulators have done the right thing. Another thing to take into account, a lot of the countries, if you look at like Scandinavia versus the US, it's also the question of size of government, which is also sort of related to this issue. And another thing that we found is that there isn't really a correlation between size of government in terms of provision of services and competitiveness. It's really the way that the money is spent, and this is the reason that you have both the US and the Nordic countries doing very, very well in the rankings.
Thank you very much. My name is Claudine from South Africa. I have 2 questions, both of them relate to methodology. I noticed that out of the 12 pillars, there are about 110 elements. Of that, only 29 are based on hard data. My question is, how hard is that hard data? Because I remember in a report last year that related to hard data, we noticed that some of the elements, and I'm speaking specifically about South Africa, related to hard data from 2004, and yet we were talking about 2007. So I have some questions about the reliability and the timeliness of the hard data. And then the second question relates to the perceptions that we see reflected in these surveys. The question is, who is your audience? Do you change it as the years go by, as you do the successive assessments? Because it may also just be one of impression. And I'll tell you why I'm asking that question. For example, for my country, I see that you have a rating here, business impact of HIV/AIDS, and it's right at the bottom. Yet if you go to the World Bank and you ask them, what is the business impact of HIV/AIDS from various countries, it's very difficult to assess. So I was wondering, are these assessments, especially the ones that are subjective, are they based on stereotypes of what one should be finding in these countries? And I'm asking these questions because the question that the earlier gentleman from WTO had asked about the economies that we find in the top 10. It's a perception. Because if I look at, for example, at my country statistics, the perceptions that are there when it comes to investors, the protection of investors, the banking, clients. So I think countries are in a very difficult situation when it comes to meeting all the expectations of both the working force and those investors. And I think one will always have a little bit of a concern, understanding that this might be the only tool out there to assess competitiveness. But I think we will always have a little bit of a concern about the absolute validity of these rankings. And also because the differences between the ranks are not that statistically significant.
Okay, first just talk about the split between survey and hard data. It has to do with weighting, and the weighting will depend upon a country's particular stage of development and the amount of data that we take. But I think it varies from 1/3 to 40% or something like that, isn't it? So we'll give more weight sometimes to the hard data. Whether hard data is really all that hard, you know, all of us that are working as applied economists to any extent know that we're slaves to the data. And we really do everything we can to have the most updated data possible. It's only really when it's not available at all that we either don't take into account any data or we go back in time. But if we feel like with macroeconomic data, for example, we don't go back in time because that's too important, it has to do with the business cycle. When it's educational enrollment data, for example, these are not things that change hugely from one year to the next. So there we feel a little bit more comfortable about taking data that's sometimes a year or two older. Now, in terms of perceptions, you know, we're asking this question of business leaders that are actually trying to do business in the economies that we're talking to. And first of all, we try not to change the wording more than to avoid it to the extent that we can, because we have time series data at this point. The more that you change the wording, the more that you change actually, you know, the ability to compare the data from one year to the next. However, every year we look very carefully at the data to make sure that it is timely, that it makes sense, that it resonates with people. Now, you're talking about survey bias and whether people in South Africa, or businesses actually, remember we were asking business leaders, had a more negative impression in this particular case of HIV/AIDS and its impact on their companies. Now, I can't tell you, because they answered this question as to how expensive it seems to them, and that was the case for all of these questions. All I can tell you is that my experience, and I think the team will tell you the same thing, is when we go around the world and present this stuff, it's really like holding up a mirror to the country. Now, you know, you might disagree a little bit about one issue or another, but people say, yeah, that's it, you know, and they just sort of see themselves in it. So that's really what we're trying to do. And through that, to really provide, as I said in the beginning, a platform for dialogue between business, the ones who are trying to create the wealth in the economy, and policymakers and civil society, but policymakers who are actually setting a lot of the context in order to improve things.
I think there was one last question here before we open the train.
Satish Joshi, Indosat. I've got a simple question. Going back to your earlier slides, you mentioned the development of 3 countries in international dollars. What do you mean? Is it US dollars or not?
Oh, that's PPP dollars. So it's in, basically that how much stuff can you buy for you know, it's making it the same basically across countries.
And there were 12 different criteria. Is there any criteria there which takes care of the social or human side of the countries and their decision makers' actual behavior? For example, although we are talking about economics, the fair distribution of the wealth among the public is one of the important points too. So in one of those 12 criteria, where does this point come in?
Well, we do look at a lot of social data in terms of access to education, and this is a very good proxy. Access to good education as well, you know, high quality education. That's a good proxy for inequality in countries. I mean, a lot of these things. We don't measure inequality per se, but we measure a lot of the things that get to the heart of that issue. Health is another issue. And I think in the future we've added into the survey questions on the quality of the healthcare system and its availability, and I think going into the future this is also something that we're going to want to add in again, which gets to the heart of the extent to which public services are being provided on an equal basis.
Shall we open it to drinks, or you want one?
It's going to be a nice question, I know.
Yes, I was wondering how you eliminate the bias in your competitiveness index. Do you eliminate subsidies in the various components of your pillar to get an unfair advantage. Subsidies, how do you eliminate the bias in your data? And secondly, how do you differentiate or avoid the bias in your data between executives who might work for government corporations who are paid to speak on behalf of the government? In other words, how do you separate propaganda from hard analysis?
Well, we don't accept any responses from government employees. We don't make a difference between, we accept responses from publicly owned companies, but these are also companies that are trying to generate wealth in the economy. So we definitely do not take into account specifically the perspective of governments, but we do take that into account also. In some countries that's basically all you have, so you have to be realistic about what you're dealing with. In terms of subsidies, we actually have questions that really get to the heart of that, like agricultural policy and the extent to which it distorts competition. Also a lot of quality issues related to the electricity system and things like that. So again, maybe not specifically asking about subsidies, but getting to that through other issues. We do think that we're, especially through the sort of the functioning markets, we ask a lot of sort of anti-monopoly questions, where you see a lot of these inefficiencies, and so a lot of it is captured there.
Thank you very much.
Thanks.
With